Very good evening, all of you. Good evening, guys. Can you please confirm the audio and video is properly clear and the screen is properly visible and clear to all of you? Good evening, Jane. Yes, Rishita, the lecture has started right now. Okay. Now, so in the last class, that is the day one of this practice to pass session, we were discussing March, June 2022 exam paper. And in the last class, we discussed question number 30. Question number 1 we discussed, right? That deals with single entity, and we discussed this question at length, and we prepared the solution also for that, right? We have prepared the solution also for that. Now today we have to discuss the another question that is from interpretation of financial statements. Now this question is from interpretation of financial statements. And now this financial statements, if you can see, is the group FS. Now tell me, guys, if I just go to the previous class notes, in interpretation I told that the question can come in the exam. Just see here, in interpretation, compare year on year or compare with the sector, compare this particular company with the sector, okay? Or there are two companies, you have to discuss which one is a better target company. Basically you have to analyze which one is a better company, okay? Now fourth is, I have acquired or disposed of a subsidiary. I have acquired a subsidiary during the year, or I have disposed of a subsidiary during the year. You have to just say whether it was a good decision or a bad decision. Now this question is from this perspective. Okay? Now one more question is from this perspective, this one. So what does it mean? That the question can get, the type of questions will get repeated, okay? So see, in March June 2022 paper, Grigori company got repeated. It's not exactly the same, but the type is the same, okay? Now, so that's what is there. Now I believe these are the questions which are very important and recommended by the examining team, and you have started solving it off, right? So now let us discuss this question now. So as you remember that we were discussing March June 2022 exam paper, and we already discussed a single one question. Now we are moving to another question that deals with interpretation of financial statements, and this financial statement is a group financial statements. In this case, when we will read the case, we will get to know that the company, the parent company, has acquired one more subsidiary during the year, and now you have to analyze whether this acquisition is a good decision or a bad decision, is what you have to analyze. Is the question the basic understanding clear, everyone? Now let's read the question. Okay, again, for those who have joined for the first time in today's class, again I will show to you how exactly to reach the ACCA exam platform, right? So just a minute. Present myself. So guys, again you have to visit acccaglobal.com. Okay, from here you have to visit ACCA students portal, study support resources. See this one, study support resources. Now from here again you have to click and move on to the ACCA qualification, ACCA full qualification. Okay, select ACCA qualification. From ACCA qualification, select the paper for which you are opting. For in our case, we are opting for financial reporting. So I will click on financial reporting. Now after clicking on financial reporting, you have to go down. Okay, Now you have to come to is past exams and question practice. Now after coming to past exam and question practice, you have to go to the login to the practice platform. Login to the practice platform. Now login. They will definitely ask your ID password. You have to enter and then go ahead. Now we are here live in the ACCA practice platform. We are here live in the ACCA practice platform. Okay, now what you have to do is you have to go to the paper financial reporting and see the resources which are available here. The past exam library, the practice exams, the specimen exams, all of them are available, right? But we are solving March June 2022. So now the assigned exams will come here, okay, March June 2022. Since we already started it yesterday, so it's already assigned to me. Now this is the question, and this is how the exam screen will also look like. So at one side you will have questions, okay, this way. Another side here on the top you will have a requirement, and on the below that will be the place where you have to solve the answers. Okay, below that will be the place where you have to solve the answer. I believe all of you are comfortable with the ACCA examining platform so far. Tell me guys, come on. All of you will be are comfortable with the ACCA examiner platform now, and all of you are solving the questions also in ACCA practice platform itself and not on the pen and notebook. You are not using pen and notebook, rather you are using ACCA practice platform to practice. Please confirm guys. Come on. Very good. So now what I've done is rather than solving on the ACCA examining platform, because as you know, notice that in the last class we have faced some issues. So I do have pasted the question in my OneNote file, and we'll discuss the question here itself. Okay, but yes, you know how exactly to write the answers in the ACCA examining platform as well now, right? Okay, so coming back to the screen, just a minute, coming back to my OneNote screen. Okay, this is the question. Now let's understand the question first, and then we'll try to answer it off. Okay, the question is quite easy. The question is very easy. Okay, now understand. Venus acquired 70% of the equity capital of Luto company. Okay, its only subsidiary on 1st January 20x8. Okay, it says that, now see what happens. It says the Venus company acquired 70% of Luto company, its only subsidiary, okay, meaning thereby prior to this acquisition it was a single company. After this acquisition it became a group company. Okay, so now what is the date of acquisition? The date of acquisition is 1st January 20x8. The date of acquisition is 1st January 20x8. Is it clear everyone? Guys? Come on, tell me. Okay, now further. On reviewing the consolidated financial statements, the managing director of Venus company was disappointed. Why disappointed? It says the managing director of the Venus company means the managing director of the group company. Okay, Venus was the parent and Luto was the subsidiary. Okay, so it says the managing director of the parent company commented he was disappointed. Why? And he commented that he had expected to see higher gross profit for 20x8 due to the receipt of discounted purchases from Luto company in the post acquisition period. Tell me guys, is he correct or not? Right? When he's saying that he's disappointed, his disappointed is valid or invalid? Tell me. Let me see who can answer it correctly too for me. His disappointment is valid or invalid? His disappointment is a valid disappointment or an invalid disappointment? Valid, then why? Invalid, then why? Come on, guys. His disappointment lies in the reason that he expected to see higher returns, higher gross profit, because there was a receipt of discounted purchase. It means there what happens, Venus company, the parent company, is purchasing certain goods from Luto company, and the Luto company gives the goods to Venus company at discount. So due to this discounted purchases, the director says that my gross profit margin should ideally increase. So is his disappointment is valid or invalid? Tell me. No one is able to answer here. Okay, let me explain the question. This line statement again. Okay, but yes, I will need answer. Okay, I have got an answer from one of the student, but still I'll explain this one. Understand what happens? It says Venus purchases certain goods from Luto. Okay, now prior to acquisition, if it would have purchased, let's suppose he purchased at 100, but after acquisition, after date of acquisition, when the Venus will purchase the same goods from Luto, it will get at 95, means the discounted, right? So it says due to this discount after the date of acquisition, due to this discount, my gross margin should ideally increase. Guys, understand? Very good, Mintu. Understand here that whenever we prepare the console financial statements, the intra group, the within the group transactions, the transactions which is done within the group are eliminated. The transactions which happens within the group gets eliminated, right? So what happens, even though there is a discounted purchase, but the purchase but these purchase in the books of Venus and the sales in the books of Luto company will get basically eliminated. Okay, so hence there will be no impact of it. Is that clear, everyone? Come on, guys, tell me. Is that clear, everyone? Okay, now, so the point which we are discussing here is this disappointment is invalid. Now it says that extracts from the draft financial statements of Venus Group, okay, and Venus Company single entity for the years 30th June 2007 and 2008 are, okay. It says see, understand, this was the year. Okay, this is 1st July x7, this is 30th June x8. Now this is first, or I'll draw it here. This is 1st July 20x7, this is 30th June 20x8, and this is 1st January 20x8. That is the date of acquisition of Luto company. Okay, so here the Venus company was a standalone company. It was a standalone company, right? Now here acquired a subsidiary, here acquired a subsidiary, right? So it becomes what? Parent plus subsidiary. It becomes a group now. It becomes a group now, right? Tell me yes or no. Tell me yes or no, guys. Now come here. That's what it says here. That's what it says. That's what it says here, right? On 30th June 2007, it was a single entity. It was a single entity, but on 30th June 2008, it becomes a consolidated. That is, it becomes a group. It becomes a group. It becomes a group. I'll write here. It becomes a group. It becomes. It was a single entity back then. Okay, that's a difference. That's a difference. Now it says that the revenue is given, cost of sales, profit, net profit, attribution of the profit is also given, and a statement of financial position extract is given. Okay, now adjustments are given. Adjustments are given. Now what does it say? Acquisition of Luto company has been accounted for correctly in the above financial statement extracts and following notes are relevant. Now what does it say? Do we need to adjust this? No, it says the accounting has been done correctly and all the adjustments are already been accounted for. So you are not required to make any adjustments. You are not required to make any adjustments. You are not required to make any adjustments to the P&L. You are not required to make any adjustments either to the P&L or to the financial position. Okay, then why it is required? Then why it is given? Let's see that. It says Luto company recognized revenue of 5 million in post acquisition period and which resulted in a profit of 2 million. Okay, fine. It says Luto company post acquisition revenue is 5 million and post acquisition profit is 2 million. Okay, fine. This is given for which company? Luto company. This is given for Luto company. Okay, now the next adjustment. Since acquisition, Venus company is able to acquire goods from Luto's company at a discount. Luto company at a discount. This has resulted in a saving of 500,000 for Venus company in the post-acquisition period. At 30th June 2008, Venus company had no inventory that has been purchased from Luto company. What is the relevance of this line? Can you anyone please tell me? What is the relevance of this line? I'll say the meaning, but someone has to tell me the relevance. When Venus has purchased, okay, sorry. Luto sold some goods. Luto sold some goods to Venus, which Venus has sold the fully to the some external party. Okay, has sold. Okay, and there are no inventory lying. There are no inventory lying. What is the relevance? What is the relevance of this line? Can anyone please answer? What is the relevance of this line? Come on guys, tell me. What is the relevance of this line? What does it imply? It implies here no unrealized profit. It just wants to say here that there is no unrealized profit. There is no concept of unrealized profit in this question. Is it clear, everyone? Is it clear, everyone? Now, coming to the next adjustment, the consideration for acquisition resulted in a share exchange and an additional 5 million to be paid on 1st January 2009. Venus company had a cost of capital of 8%, which is equivalent to the discount factor of 0.96. Okay, now what did it say? It says, see, Venus company acquired how many percentage? How much percentage? 70%, if I'm not wrong. 70, yeah. Venus company acquired 70% of Lotus company, and Venus company will definitely pay the consideration. So it says the consideration which is being paid by way of a share exchange plus $5 million, okay, to be paid on 1st January 2009. What was the date of acquisition? What was the date of acquisition? Date of acquisition was 1st January 2008. You are paying $5 million on 1st January 2009. So what is it? What is it? It's called as deferred consideration. And how do we record deferred consideration? At its present value. So what is the present value factor given? 0.926. So can anyone please help me in calculating what is the present value of it? 5,000 multiplied by 0.926 is how much? 4630. 4630, right, is the present value of it. Now further it says the fair value of the Luto company assets at acquisition were equal to the carrying amount except for an item of plant. This plant has a remaining life of 3 years. At the date of acquisition its fair value was $900,000 above its carrying amount. Okay, Venus company assets are held at historical cost. Okay, fine. All the revenue and expenses are deemed to accrue evenly throughout the year. Okay, fine. Now it says the following pre-formatted table relates to part B1 of the question and has been replicated in the response area. Okay, fine. Now this is the question. This is the question. So what does the question say so far? The question says that I have acquired a subsidiary, and in the at the opening I was a single entity. At the opening I was a single entity. At the closing I am a group, that is the parent plus subsidiary. The acquisition is a mid-year acquisition. The acquisition is a mid-year acquisition. Okay, so the P&L for the previous year as a single entity is given. The P&L for the current year as a console P&L is given. Okay, now the question also gives you certain adjustments, but the question clearly mentions that the accounting is done correctly. But the question clearly mentions that the accounting is done correctly. Is the question clear so far? Before we go on to the requirement, whatever we have discussed, is the question clear so far? Now I want to discuss few things. If at all, though the question clearly says that the accounting has been done correctly, but now can we discuss the accounting treatment of each and every adjustments? If at all we had to do, what we would have done? First one, Luto company recognized revenue of 5 million in the post acquisition profit, which resulted in a profit of $2 million, meaning thereby 5 million would have got added to the P&L. See here, the revenue is 39,000. The console revenue is 39,000. Out of which, what is the meaning of it? What the meaning is, Venus and Luto. Luto is 5,000 and Venus is 34,000. Is that clear? Is that clear? Venus plus Luto comes to the group console P&L, right? Console revenue. Now the next part is which resulted in a profit of 2 million. Okay, fine. So now the question doesn't say gross profit or net profit, so I'm assuming it to be net profit. Okay, now because when the word gross is silent, I will assume any profit as net profit only, profit for the year. Okay, so the question doesn't give any details about the cost of sales of the Luto company, so I'm not commenting upon that anything. Okay, now coming to further, Venus company is able to acquire goods from Luto at a discount. Tell me, will it have any impact? Will it have any impact on the console P&L? Will it have any impact on the console P&L? Will it have any impact on the console P&L? What will we do? We will just add up the cost of sales of the Venus plus Luto for post acquisition. Right, but understand guys, we are required to do one more thing. Okay, so stating 34,000 might be wrong here, because the question does not give us the detail. The question does not give us the details of goods transferred by Luto to Venus. What was the amount of goods that was transferred by Luto to Venus? And that is within the group sales or purchases. So we will have to eliminate it. We will have to eliminate it from the revenue and cost of sales. We'll have to eliminate it from the revenue and cost of sales. Is that clear, everyone? Now, okay, further, point number 3, the consideration for the share acquisition consisted of share exchange and additional sum of $5 million to be paid on. Now see the equity share capital. The equity share capital has increased from 20,000 to 30,000. The share premium has increased by here also, right? By how much? 10k. Here how much? 30k. So this is what? This increase is due to issue of shares. This increase is due to issue of shares in say in during on date of acquisition, on date of acquisition. Okay, on date of acquisition. Now, what should be the journal entry for this one? The journal entry will be investments account debit to share capital and share premium and to deferred consideration. Deferred consideration will be recorded at what value? 4630, right? So this should be the treatment of this one. Now, so these are the first three treatments. Coming to the fourth treatment, fair value. Now what happens to this fair valuation? So whatever is the fair value gain or loss, we add on the date of acquisition net assets. But now, since we are doing a mandatory fair valuation exercise of the assets and liabilities on the date of acquisition, so it will have a consequential impact on the post acquisition profit or loss. Now here what we are doing, we are saying that the fair value of the Luto company assets on acquisition were equal to the carrying amount except an item of plant. This plant had a remaining life of 3 years at the date of acquisition.Its fair value was $900,000 above its carrying amount. So this $900,000 we would have already added plus 900,000 on date of acquisition, and on post acquisition profits, we would have adjusted the excess depreciation on account of this fair valuation exercise. What is the excess depreciation? 900 is the fair valuation exercise. The remaining life is 3 years. Okay, now we have to do it for the part of the year because the subsidiary was acquired on 1st January 2008 and we are preparing the financial statements on 30th June 2008 for 6 months. So what is the amount? 900 by 3, 150. Very good, Mintu. Okay, now all revenue and expenses were deemed to accrue evenly throughout the year. Fine. Now let's understand the requirement. Now I believe the question is very much clear to all of you. Again I will reiterate one same thing again and again, is all these adjustments are already done in the question, so we are not going to do that again. Okay, why exactly? Because the question clearly mentions accounted for correctly. The acquisition is accounted correctly. So if it is accounted correctly, means everything has been taken care of in the console P&L and the console balance sheet, console statement of financial position. Everything would have been taken care correctly. Okay, so now we are definitely not amending the console P&L and the console statement of financial position, but now we will read the requirements and answer it accordingly. So what is the requirement? Now let's read it. Based on the extracts provided, use the pre-formatted table to calculate the following ratios for Venus Company and the Venus Group for the years ended 30th June 2008 and 2007 respectively. Okay, what are the ratios? Gross profit percentage, net profit percentage, and return on equity. Now see here, see the question. Equity should include NCI where applicable. Now it says you have to calculate return on equity, and the question clearly says that you have to include NCI as part of equity. This might have been a confusion for many of the students, but this confusion has been ended. So the examiner is trying to make things easy for you. Okay, now let's solve it. This I think is a free lunch. Okay, a birthday gift sort of thing. Now gross profit for 20x8 and 20x7. In 20x8 it was a group, and in 20x7 it was single entity. Now I will not be using this space because it's too small to use it off. I'll make known. One is gross profit. This is for 20x8 and this is for 20x7. So what is the formula for gross profit margin? It is GP upon sales multiplied by 100 percentage. Now for 20x8 and for 20x7, what is the GP and sales? The GP is 12,500 and this is the GP is 12,500 and 11,000. Let me write here. The GP is 12,500 and 11,000. Right, the sales is 39,000 and 32,000. So what does it come to? 12,500 divided by 39,000 is multiplied by 100 is 32.05 percentage, and 11 divided by 32, 34.38 percentage. Now second is gross profit, net profit. What is the formula for net profit? The net profit formula is net profit upon sales multiplied by 100%. Now what is the net profit, guys, for both the year? What is the net profit? 8,900 and 9,200. The net profit is 8,900 for this year and 92 here. The profit for the owners 9,200, 8,900 and 9,200. 8,900 for this year and 9,200 is for this year, divided by 39,000 divided by 32,000. The amount that comes is 9,200 divided by 39,000 multiplied by 100 is 23.5. Okay, do we need to take NCI also? Just a minute, guys. What is the question asking? We have to include NCI. Okay, it's asking to include NCI, so we have to include NCI in the numerator also, right? We'll take 9,800. So 9,800 is 9,800 divided by 39,000. 9,800 divided by 39,000 is 25.13 percentage. Okay, now is 8,900 divided by 32,000, 27.81 percentage. Okay, now return on equity. Can anyone tell me what is the formula for return on equity? What is the formula for return on equity, guys? Can anyone tell me? What is the formula for return on equity? Come on, guys, tell me. Net profit upon equity. Okay, net profit for the tax, it is profit for the year divided by equity. Now what is the net profit that is given here? 9,800 on 8,900 on what is the equity? Equity is given in the question, no need to calculate. Equity is given as 87,500, 42,000, 87,500 and 42,000. That comes to 9800 divided by 375. 7.2%, and 8900 divided by 42,000, 1 point. This is the ratios calculation. I believe this is very easy, which you can calculate in a fraction of minutes, right? That's not a challenge. Right? Is that clear, everyone? Come on, guys, tell me, is that clear, everyone? Is this requirement clear, everyone? Requirement number A is clear, everyone? Can I move on to the further requirements? Come on, guys, tell me. Okay, now move on. Let's move on to the next requirement, that is part B, part 1. Part B1. Complete the table provided. Now listen to me very carefully, all of you. Okay, listen to me very carefully. In net profit NCI also. Okay. Net profit generally means net profit, that is profit attributable to the owners of the company. But now see, the question gives us a hint here. Equity should include NCI. Now if in the denominator you are including NCI, don't you think you should include that in the profit also? Tell me, Mintu. Right? The question gives us a hint. That you have to include NCI as part of equity. So if NCI is a part in the equity, now understand, when you are calculating a return on equity, you will say profit after tax, and right here profit for owners divided by equity. Agree? But the question says to include NCI here. So don't you think I will include NCI here as well? Right? That's what is said in the question. Okay. Just cut it off. Where else? Now coming back to the requirement B1. Complete the table provided. Complete the table provided to adjust Venus Company on consolidated profit for the year ended 30th June 2008 in order to calculate the profit of Venus Company for that year if the acquisition of Luto Company had not taken place. What does it mean to say? See, understand. It says complete the table. There will be definitely a table given. Okay, we'll see what table it is given. Okay, complete the table to adjust the Venus Company console P&L. It says complete the table to adjust the Venus Company console P&L, to adjust the Venus Company console P&L, to adjust the Venus Company console P&L, that is 9800, that is 9800, that is 9800, to adjust the 9800 for what? In order to calculate the profit of Venus Company for that year as if acquisition of Luto had not taken place. Means it says that you have to make adjustments to this 9800. You have to make adjustments to this 9800 to arrive at the profit of Venus as a single entity. I will write in one word. It says calculate. What is the requirement? It says calculate the profit of Venus company, calculate the profit of Venus company, calculate the profit of Venus company if as a single entity, as a single entity for 30th June 20x8, means if the what is the name? The name is also something very just a minute. What is the name of that company acquired? Luto. Yeah, if the Luto company would not have been acquired during the year, if the Luto company would not have been acquired during the year, what would have been the the profitability of Venus company? What would have been the profitability of Venus company? Now, what is the table given? See here, the table that is given. It says calculation of adjusted profit. Now it is starting with the console profit for the year, that is 9800. It is starting with console profit of that is 9800. Then it is asking you to do the adjustments and then arrive at this profit, and then arrive at this profit. Okay, arrive at this profit. Arrive at this profit. And then arrive at this profit. Okay, now how will you arrive at this profit? Okay, the question also gives you, see, you should be very much thankful to the examining team. Whoever has said the question was very much thinking from the student's perspective. Okay, he was very much thinking from the student's perspective. Okay, ideally this was sufficient, but now they are giving this just like a climber tree. It's a support that is given. It's a support that is given to the students. Okay, so they write here, you have to give the impact of adjustment number 1, you have to give the impact of adjustment number 2, you have to give the impact of adjustment number 3, you have to give the impact of adjustment number 4, which is linked with note 1, which is linked with note 1, note 2, note 3, note 4. And not only here, not only till this one, it also gives you an illustration of how exactly you have to do this one. 2000, why 2000? See, 2000 is here. What was the profit that was earned by Luto company post acquisition is 2 million, right? So it is removing the impact of acquisition of Luto company. Okay, it is removing that impact. It is removing that impact. So it also not only it gives a table, it gives a table as support to the students, but also it explains that how exactly you have to move ahead. How exactly you have to move ahead. That is, it explains by removing the profit of Luto company. Is it clear, everyone? So it explains this one. Now these three details you have to calculate. These three details you have to calculate. Adjustment number 2 to be completed. Note number 2. From note number 2, what is the adjustment to be done? Okay, now read this note. Read this note and tell me what is the adjustment to be done. It says, since I have acquired, since the Venus company has acquired Luto company, since Venus company has acquired Luto company, it has got a discount of 500,000. If it would not have acquired this company, do you think this discount of 500 would have been given? This discount of 500 would have been given? This discount of 500 would have been given? Tell me. Do you think this discount of 500 would have been given? No. This discount of 500 would not have been given. So what will I say? What will I do with this one? This is a benefit. This is a benefit of 500,000 in the console books. This is a benefit of 500,000 in the console books. This is a benefit of 500,000 in the console books. So benefit, now this if I will remove that subsidiary, this benefit will not exist. This benefit will not exist. So I will have to reduce the benefit. I will have to reduce the benefit. Okay, so what will I do? I will write here negative 500. Negative 500. Okay, you have to remove all the benefits. You have to remove all the expenses. Now what's the next? Adjustment number 3, note 3. What is the adjustment number 3, guys? Consideration. Now see when you issue the shares, is there any subsequent treatment for that? No. When you issue the shares, you just write investments account debit to share capital to securities premium and to deferred consideration. But now deferred consideration does have subsequent treatment in the form of finance costs, right? So finance cost on deferred consideration would have been added to the finance cost, which would have reduced my profitability, Now I have to increase the profitability, so I will add back the finance cost. I will add back finance costs. And what is the amount of finance costs? I will write here add back finance costs on deferred consideration. The amount cannot here. Yeah. The amount here is, we calculate is like this. 4630 was the amount of deferred consideration, if I am not wrong. 5000 into 0.926 is 4630. What was the discount rate? Guys? Discount rate was 8%. Multiplied by 8% multiplied by 1 by 2, because from 1 January to 30th June, 6 months. Okay, so what does it become? 4630 multiplied by 0.08 divided by 2 is 185. I will add back. Okay, less is a benefit of discount. Okay, now is these two adjustments clear to everyone? Are these two adjustments clear to everyone? Very good. Okay, now adjustment number 4 relates to note number 4. What is the note number 4? Fair valuation. Okay, now we have already calculated here, no? This is the impact of post acquisition profits, the excess depreciation. Understand, guys, on the fair valuation exercise, what do we do? Whatever is the excess fair value over and above the carrying amount, we add, or basically we adjust on the date of acquisition. But due to this fair valuation exercise, there is a consequential impact of excess depreciation on the post acquisition profits. There is a consequential impact of excess depreciation on the post acquisition profits. So what is the excess depreciation? 150. Depreciation is an expense which would have reduced my profitability. Now I will add back. Add excess depreciation of 150. So what is the net profitability? The profitability is 9800 minus 2000 minus 500 plus 185 plus 150 is 7635. Is 7635. Is this clear to all of you? Is it clear to all of you? Come on, guys, tell me. Is it clear to all of you? Now, the question doesn't stop here. The question says calculate net profit percentage. Okay, now the net profit percentage means net profit by sales multiplied by 100%. So the net profit is 7635. The revenue was how much? 39,000 multiplied by 100%. Is this correct? Let me see who can answer it. Is this correct? Is this net profit percentage calculation correct? Come on, guys, tell me. No. Why no? What is the mistake here? Revenue 34. Wonderful. Basically, I have to remove the profit, the revenue of Venus company. I have to remove the revenue of Luto company. I have to remove the revenue of Luto company. Now, so what is the amount? So it is 7635 divided by 34,000 into 100 is 22.45%. Is it clear, everyone? You didn't account for NCI. But what is the requirement for accounting here for NCI? Tell me, Elaine. I'm sorry if I misspelled your name, but can you please tell me what is the need for accounting for NCI? It is just asking you to calculate the profit of Venus if it was a single company, if it was a single entity. The profitability of Venus if it was a single company. So what I did, I took first the console profit, then all the console adjustments which was done, I just removed the impact of it. Okay, if I have recorded an expense in the console P&L, I added back the expense. If I have recorded an income in the console P&L, I reduced that income. That's what I did, and I arrived at a profit of the Venus company if it was a single company. Muskan, okay, 4630, from where did it come? Okay, it comes from here. See, while I was explaining the question, I explained it here that the deferred consideration was 5 million. The deferred consideration was see here 5 million, and the cost of capital is 8%, which is equivalent to 0.926. So if you multiply 5,000 multiply the 0.926, it comes to 4630. Okay, Ilan and Muskan, are your queries cleared? It's not about no acquisition anymore, Ilan. It says, the question says that, see, read the question, Ilan. It says calculate the profitability of Venus company as if the acquisition of Luto company had not taken place. What would have been the profit of Venus company if Luto company would not have been acquired? Now, it's think of it this way. It says the console profit of Venus company is 9800. Now, the managing director of Venus company is sitting like this at the year end and thinking, if I would not have acquired Luto company, what would have been my profit? If I would have not acquired this company, what would have been my profit? Okay, definitely, see, understand. If you have done this task, if you do any task, okay, definitely after doing that task, you analyze, right? If I would have not done this task, what would have been the scenario? Since I have done, I know this is the scenario, but what if I have not done it? What would have been the scenario? That's what is being assessed here. Okay, good. Now, that's what is point number B1. So I believe this is also clear to all of you. Coming to point number B2, that's a theoretical and a very generic question, I believe all of you can answer this part, and there is no requirement for me to discuss, but still, since it's a part of the question, I'm definitely required to discuss it off. Explain why console financial statements for those of the Venus group are not comparable to those of the single entity Venus. It says, see, B2. It says on 30th June 20x8 and on 30th June 20x7, this Venus was a single entity, okay, and here Venus is a group. Okay, it says they are not comparable. The question is why? You have to write 3 reasons for that. You have to write 3 reasons for that. Can you please specify the reasons? I really don't want to discuss the question, but please tell me, guys. But I need answers from you. Okay, Muskan, tell me, what do you think is the impact of that 5 million that we pay for acquiring subsidiary? In the P&L, what is the impact of that? Okay, yes, 5 million means it's a deferred consideration I'm talking, right? What is the impact in the P&L? Tell me. What is the impact in the consolidated profit and loss? Tell me. Muskan, tell me. What is the impact of the 4630, that is the deferred consideration, in the console P&L? What is the impact? Finance cost, right? And we have already done the adjustment for that. See here, add finance costs on deferred consideration. That's done. I hope your query is cleared now. Okay, now I will not be going back to the same question again and again. Okay, now please tell me, question number B2, what are the reasons that they are not comparable? Anyone? Come on, guys, tell me. Why do you think they are not comparable? Why do you think that they are not comparable? Tell me, guys, come on. Why do you think that they are not comparable? Why do you think that they are not comparable? Because of the intra-group transaction profit increase. Rahul, do you think due to the transactions within the group that happens, the profitability increases or decreases? I don't think so, because we eliminate the transactions which happens within the group, so it doesn't impact my profitability. Guys, understand what happens. The reason is in front of you in the screen. Here it was only Venus. Here it is Venus plus Luto both. How can you compare these two? And that too, Luto is for part of the year. Luto is for the part of the year. How can you compare these two? You can compare Venus of 1 year with Venus of another year, but you cannot compare Venus of 1 year plus Venus of another year plus Luto of another year. You cannot compare that, right? You cannot compare that. You cannot, exactly, Ellen, exactly. So you cannot compare that. Okay, so first reason is parent versus parent plus subsidiary are not comparable. Okay, second, finance cost is something which is coming as an additional line item, in 20x8, but it was not there in 20x7, and this is coming due to acquisition. Right? So this makes again not comparable. Right? Now from a P&L perspective, again, Luto company, we are preparing for the part of the year. Again, it becomes uncomparable. Now, when we talk about the assets, when we talk about the SOFP, SOFP for the previous year is only for the Venus. SOFP for the current year is for the Venus and Luto both. Again, so it is again not comparable. Is it clear, everyone? So these are the reasons, these are the multiple reasons. The question has asked for a minute. 3 marks, but you can write as good as 4-5 points. But yes, in the exam, don't write much, write what is required. So 3 marks, 3 points. Okay, 3 reasons is more than sufficient. So you can write that. Now coming on to the last point. See, guys, out of 20 marks, I believe 3 marks, 5 marks, and 3 marks again. 3, 5, 8, 8 plus 3, 11. 11 marks was 11 marks was quite easier to score. Out of 20, 11 marks was quite easier to score. Was quite easier, And the best part is you can score 11 out of 11 also in this one. You can score 11 out of 11 in this one. And here 9 marks, where students generally struggle to write answer. Even if you score 4 or 5 out of 8, so 11 plus 4 or 5 is 16. 16 out of 20 is not a bad deal. It's not a bad deal. It's not a bad deal. Okay, it's a really good deal. I will say it comes under top scorer marks. Okay, so 16 out of 20 is a very good mark. Okay, so now what is this part number C? Based on your answers to part A and part B, comment on the comparative performance of winners for the years 30th June 2007 to 2008, specifically discussing the managing director comments for 9 marks. So you have to write at least 9 comments. Okay, we'll try to discuss some of them. Now understand. Let's start from the top. Whenever the question says comment on the performance, start from revenue. So now what is happening? Revenue is increasing from 32,000 to 39,000, meaning thereby the revenue is increasing by 7,000. Interpretation, part C. Now, revenue increases from 32,000 to 39,000, that is by 7,000, and this 7,000 increase, out of which 5,000 is for Luto company, right? This is the first comment that you can write. Second, coming to gross profit. The gross profit is increased by 11,000 to 12,500. Okay, gross profit. This is first comment. Second comment is gross profit has increased from we do have calculated percentage also, right? We have calculated percentages also. Let's compare the percentages. 34.38 to 32.05. 34.38 in the previous year to 32.05% in the current year. Not increased, it's decreased. Why it has decreased? Tell me. Why the gross profit has decreased? See, understand. In the previous year and in the current year, it was revenue of Venus, it was costs of Venus, and it was gross profit of Venus, right? In the current year, the revenue is for Venus plus half Luto, cost is for Venus plus half Luto, and then gross profit is coming up. Possibly, not exactly, we don't know. Possibly the gross profit percentage of Luto company might be lower, and which had a reducing impact onto the gross profitability of the grow, right? Possibly it can be the case, right? Though we are not commenting exactly, we are saying possibly this can be the case. Okay, now the third one, the third point is we have calculated net profit also, right? Net profit has decreased from 27.8 to 25.13, and has decreased again. It has also decreased from 27.8 percentage to 25.13 percentage, right? Now why it has decreased? Okay, though we don't have the analysis of the costs to comment upon that, but yes, we can definitely give a comment. Let's see, this is for the previous current year, and sorry, this is for the previous year and this is for the current year, right? So it has decreased. This decrease is definitely due to decrease in the net profit margin of Venus as a single entity. Can you tell me why this decrease is not due to this decrease is not attributable to the acquisition of subsidiary, that is Luto company? No, why? Because I will tell you, the net profit of Venus company is 22.45. see here, we have calculated the net profit of Venus company. We have calculated, if the Luto company would not have been acquired, what would have been the net profit of Luto? We have already Venus we have already calculated, right? Because the net profit, we have already calculated the net profit of Venus without Luto is 22.45. To understand, in the previous year it was something 27.8. In the current year it has reduced to 22.45, but now the current the net profit is 25.13, means due to subsidiary the net profit margin is increasing. Due to this acquisition, the net profit margin is increasing. I hope you are understanding the point which I am trying to say here. Understanding the point which I am trying to say here. The point which I am trying to say here is, see this one, the Venus as a single entity. The net profit margin of previous year and current year. Previous year is 27.8 percentage, is 22.45 percentage, right? Now net profit margin for Venus plus Luto is 25.81, if I'm not wrong, 25.13 percentage. Meaning thereby, see, if we compare standalone, the net profit margin has reduced significantly. It is because of the subsidiary, the net profit has increased to 25.13 percentage. And the managing director is commenting. What is the comment of managing director? That due to acquisition, my profitability has reduced. Tell me, is it the reduced due to profit? Is it the reduced due to acquisition? No. Due to acquisition, there is an increasing impact on net profit margin. Because if I would not have been acquired the subsidiary, my net profit would have been 22.45. It is because when I've acquired a subsidiary, my net profit is 25.13 percentage. Increasing impact. Is it clear, everyone? Is it clear, everyone? Is it clear, everyone? Now, further. Return on equity. We have discussed many points here in this one. Fourth is 1, 2, 3. Return on equity. Return on equity. Now what happens? Return on equity decreases or increases? 21.2 to 11.2. 21.2 in the previous year to 11.2 in the current year. Means what? Decreases significantly. Decreases significantly, irrespective of the fact that the net profit increases. Net profit has increases from increase or decrease. Just a minute. I believe increase. 89 to 92, 89 to 98. Increases from 8900 in the previous year. 8900 in the previous year to 9800 in current year. The net profit has increased, still the return on equity decreases. Why? Due to increase of equity. Now see, what is the increase of equity? See here. The equity was 42,000 in the previous year, but it has increased to 87,500. More than double. The denominator has increased more than double. The denominator, that is net profit by equity. So the denominator equity has increased by more than double, and it is because of that reason your return on equity decreases. And now why has equity increased? Due to issue of shares. On a share exchange consideration, okay, and non-controlling interest, and retained earnings also increases. Why? Because the profitability of Luto has also been increased here. Okay, now, so these are the adjustments. Any further adjustments? No. Further, you have to, after writing all these analysis, you have to comment. On managing directors. Comment. That is, due to acquisition, the net profitability of the company has reduced. No, you have to write no. The managing director is wrong here. Why? Because since due to acquisition, the net profitability has not reduced, rather the profitability has increased, because if this company would not have been acquired, my profitability would have further reduced to 22.45%, and it is because this subsidiary has been acquired, the net profit goes high to 25.13%, okay. Though even there is a decrease from previous year as compared to previous year, but if the subsidiary would not have been acquired, there would have been a further decrease. Okay, so the acquisition subsidiary is a good move. Now further, after that also you have to write a conclusion. That's all, and that's all about the analysis. And the interpretation. Muskan, can you please? Muskan is asking, can you please tell how to do these workings in the Excel sheet? Why are you required to do these workings in the Excel sheet? If you, I'll just show in the exam platform also manner also. Just give me a minute. See, in the exam, a format is already given. You are required to write here what we did here. Just a minute. So you are required 12,500 divided by 39,000 is equals to 32.05%. That's how you have to write here. %. That's all you are required to do. Here you have to write 9,800 divided by 39,000 is equals to 25.13%. Here you are required to write 9,800 divided by 87,500 is equals to 11.2%. Right? So that's how you are required to solve in the exam. Again, for the previous year also you can solve it like this: 11,000 divided by 32,000 is equals to 34.38%. Here again it will be 8,900 divided by 32,000 is equals to 27.81 percentage, and here again you can write 8900 divided by 42,000 is equals to 21.2 percentage. That's how you have to solve in the exam. Is that clear, Muskan? Now if you come here, again the pre-formatted table is given. Even if in the exam this pre-formatted table is not given, you can write it, you can make the table. See, there is an option to make a table. There is an option to make a table. You can make a table and you can write it off. Okay. Now 98 and 200 is given. Now here you can write here, you can just delete this part. Okay, and you can write here what exactly we have written. I'll just copy paste there. Minus 500. Okay, then you can write here minus 500, then 185, and then you can write here 150. You can write here the reasons, benefit of discount, and highlight it off. You can write here add back, finance costs on deferred consideration. You can write in the bracket 4630 in multiplied by 8% multiplied by 6 by 12. Okay. Now further you can write here again add back excess depreciation on fair value adjustment. Okay, that is 900 divided by 3 years into 6 by 12. Okay, that is 150. Okay, again highlight it here, right? This is done. So now you can write here to be calculated 7635. The net profit is 7635. And here you can net profit, you can write here net profit working is 7635 divided by 39,000 minus 5,000. Okay, so it is coming to 22.45 percentage. That's how you have to write in the exam. Might be some challenge. You can please retry. It will definitely happen. Okay, all the students are doing it like this itself. Okay, so don't worry at all about it. That's all about the ACCA past exam paper. Okay, now our practice to pass session will end here itself, but yes, I have to discuss certain more things. I have to discuss few more things. Okay, let me come back to my screen. Okay, exam tips. Guys, understand that I have definitely discussed one past paper with you guys, wherein you can understand how exactly you have to approach a question, how exactly you have to solve in ACCA practice platform, and how exactly you can save your time also. Okay, now understand guys how exactly, or what are the last minute exam tips. For financial reporting, what you have to do now. Okay, see, what you have to do is today you have around 7 days remaining, right? You have around 7 days remaining for the exam, around 7 days. Okay, around 7 days remaining for the exam. So what you have to do is solve selected questions which I have already given, plus okay, given by me, plus by selected by you. Okay, solve it off. Further, read technical articles. Okay, solve at least 2 mocks, solve at least 2 mocks in an exam timed manner. In an exam timed manner. Okay. Last day, what will you do? Okay. Okay, you can solve questions, solve important questions which you think are important, or important adjustments, revise important adjustments. Okay, or you can read important topics which you feel is relevant. But yes, few things that you have to definitely take care of: sleep properly, sleep properly. If you are not doing this, definitely exam might get impacted. Okay, so please sleep properly, eat properly, don't eat too heavy. Okay, eat light, but eat properly. Okay, now, and keep a few things ready with you in the exam hall. The watch, mobile phones, nothing is allowed. You can take a calculator like this. Okay, you can take a calculator like this to the exam hall. Okay, it is definitely allowed. You can take the scientific calculator also, that is also allowed, though. Okay, now further, now please keep a original document proof with you guys. Further, please keep a document, a docket, a copy, print of the docket copy ready with you. Okay, don't carry any other things to the exam hall. Okay, and keep your mind chilled, keep your mind chilled. Okay, whatever you have to study, you have studied well. Last 6 days, study well. Last 24 hours, enjoy. Okay, study whatever you want to, but don't take extra load in the mind. Okay, don't take extra load. That's all I'll say. Okay, all the best from my side. Keep exams well, do give exams well. Okay, and succeed with a amazing marks. Okay, but always remember, in the exam, your first priority is to score 50 marks, and then whatever you want to score is good. Okay, is something extra that you are getting. First priority should be 50 marks. First priority should be 50 marks. Okay, that's all from my side, guys. I hope no one has any queries, but still, if you have any queries, I believe all of you have my number, but still I'm giving it again. This is my contact number. You can WhatsApp me in case you have any queries. Please WhatsApp, don't call. I might not be able to receive calls if I'm in class. So please WhatsApp me in case you have any queries. We'll discuss that. Okay. Now that's all for the day, guys. Thank you. Bye bye. And the practice to pass session ends today. Okay. Bye bye.